The biggest financial mistake most people make feels like the safest decision of all. Holding $100,000 in cash is far riskier than most people realize. Most people believe that keeping money in the bank is the safest financial decision they can make. It feels responsible. It feels mature. It feels careful. You work hard. You save money. You put it somewhere secure. And when you check your account balance, you feel calm. But the most dangerous financial mistakes are not the ones that feel reckless. They are the ones that feel safe. Let's begin with a simple example. Imagine you have $100,000 in cash. You didn't inherit it. You didn't gamble for it. You earned it slowly over many years. So you do what most people are taught to do. You put it in the bank, not under a mattress, not in something risky. A bank, a place that feels solid, regulated, protected. You choose a high-yield savings account. Today, many banks in the United States pay around 4% per year. So after 1 year, your bank pays you $4,000 in interest. Your account balance now shows $104,000. You feel good. You feel like you made a smart decision. Now, let's talk about the part most people ignore. That same year, inflation is 5%. That means the cost of living has increased. Rent, food, energy, health care, insurance, all more expensive. Your $100,000 now needs to be $105,000 just to buy the same things as before. So what really happened? You earned $4,000 in interest, but you lost $5,000 in purchasing power. You are $1,000 poorer, even though the number in your bank account went up. No one took your money. There was no market crash, no recession, no panic. The value simply disappeared quietly. This is why inflation is so dangerous. It doesn't feel like a loss. There is no transaction, no warning message. Your money doesn't vanish overnight. It erodes slowly, year after year. And because it happens gradually, most people never react. They keep doing the same thing. They keep saving. They keep depositing. They keep feeling safe, while the real value of their money keeps shrinking. Here is an important distinction most people never learn. Safety is about how something feels today. Security is about how it performs over time. Cash feels safe, but cash is not secure. Security means protecting your purchasing power over long periods. 10 years, 20 years, 30 years. And cash, by itself, has failed that test repeatedly throughout history. Let's stretch the timeline. Imagine you keep that $100,000 in cash for 20 years. Let's assume inflation averages a modest 3% per year, not extreme, not a crisis, just normal inflation. After 20 years, your money loses almost 45% of its purchasing power. That means your $100,000 now buys what $55,000 used to buy. You didn't spend it. You didn't waste it. You just waited, and waiting was enough to lose nearly half its value. This is why wealthy people say doing nothing is often the most expensive decision. You might wonder, if this is true, why doesn't the bank tell me? Because banks don't exist to protect your purchasing power. They exist to store your money, lend it out, and earn a spread. From the bank's perspective, you did exactly what they wanted. You deposited cash. You accepted low real returns. You took the inflation risk quietly. Cash gives people a sense of control. You can access it anytime. You can see it. You can count it. And psychologically, that feels powerful. But control over a number is not the same as control over value. Wealth is not about the number on a statement. It's about what that number can do for you in the real world. And over time, cash does less and less. Most people are far more afraid of market volatility than inflation. A stock market drop feels dramatic. The news talks about it. People panic, but inflation is boring. No headlines, no urgency. Yet, inflation is far more reliable. Markets go up and down. Inflation only goes one direction. Wealthy people define risk differently. They don't define risk as volatility. They define risk as permanent loss of purchasing power. A 20% market drop that eventually recovers is not real risk. Losing 3 out of 5% of your purchasing power every year with no recovery is real risk, and that is exactly what cash does. Over the past century, every major currency has lost the majority of its value, not because of failure, not because of collapse, but because inflation is built into the system. Governments print money, economies grow, prices rise. Cash is designed to circulate, not to store value forever. Yet most people try to use it as a long-term store of wealth, and that mismatch is where the problem begins. So why do people still do it? Because cash feels stable. Cash feels predictable. Cash feels familiar, and familiarity feels safe. But familiarity is not a strategy. Comfort is not a plan. There is a deeper psychological reason. Holding cash avoids discomfort, no decisions, no uncertainty, no learning curve. Investing requires thinking. It requires patience. It requires accepting short-term uncertainty for long-term gain. Cash requires none of that, and that is precisely why it underperforms. Many people say, "I don't care about returns. I just want peace of mind." But peace of mind has a cost. If peace of mind costs you your future purchasing power, it may be more expensive than you realize. The question is not, does this feel safe today? The question is, what will this decision cost me 10 or 20 years from now? Wealthy people don't keep large amounts of cash because they trust banks. They keep cash for liquidity, not growth. They understand cash has a role, but it is a short-term tool, not a long-term solution. They don't ask, "Where is my money safest?" They ask, "Where is my money most protected from losing value?" Those are very different questions. The most dangerous place financially is not being reckless. It is being almost responsible, saving diligently, avoiding obvious mistakes, but never learning how money actually works. That's where many people stay stuck. They do everything right and still fall behind, not because they failed, but because the rules they followed were incomplete. Inflation causes a silent transfer of wealth from savers to borrowers, from people who hold cash to people who own assets, from those who wait to those who position themselves. This is not a conspiracy. It is a system. And once you understand the system, you stop blaming yourself. You start changing your strategy. Understanding the illusion of cash is the first step. But it's not enough to know what doesn't work. You need to understand what wealthy people do instead, not to speculate, not to gamble, but to protect and grow value over decades. Once you understand why cash slowly loses value, the next question becomes obvious. If cash is not a reliable, long-term store of wealth, then what do wealthy people use instead? The answer is not speculation. It is not chasing trends. It is not gambling on the next big thing. Wealthy people focus on assets. Assets that either grow with inflation, produce income, or protect purchasing power over time. Not perfectly, not instantly, but consistently. Let's walk through the 5 categories of assets that wealthy people have relied on for generations. Asset, sure. Ownership in businesses. At the core of almost all long-term wealth is ownership, not employment, not wages. Ownership. When you own a business, you own productivity. You own the ability to convert effort, capital, and ideas into value. Why businesses outperform cash. Let's take a simple example. A company sells a product for $3. Its costs are materials, labor, rent, energy. When inflation rises, those costs increase. But a well-run business does something important. It raises prices. That $3 product becomes $330. Customers complain briefly. Then they adjust. The business survives. Often it grows. Cash cannot do this. Cash cannot raise its own value. Cash cannot respond to inflation. Businesses can. Over long periods, business ownership has consistently outpaced inflation. Not every company succeeds, but ownership of productive enterprises as a group has been one of the most reliable wealth-building tools in history. This is why wealthy families often hold businesses for decades, not for excitement, for durability. When you own a business, inflation works for you, not against you. Prices rise, revenue rises, nominal profits increase. Cash holders lose purchasing power. Business owners adapt. Asset to income-producing real estate. Real estate plays a unique role in wealth preservation, not because property always goes up, but because it combines income and inflation protection. A practical example. Imagine you purchase a rental property for $200,000. You put down a reasonable down payment and finance the rest. At the beginning, monthly rent, $200. Mortgage payment, fixed. Over time, inflation occurs. Rents rise. Wages rise. The value of money falls. 10 years later, monthly rent, read $800. Mortgage payment, largely unchanged. Your income rises. Your debt does not. Inflation quietly transfers value from lender to owner. Why real estate favors patience. Real estate rewards long holding periods. Conservative leverage, stable demand. It punishes over-speculation, short-term flipping, excessive debt. Wealthy investors don't buy property hoping for fast appreciation. They buy it to generate cash flow, preserve value, reduce reliance on wages. Real estate allows you to earn income, hedge inflation, use long-term financing. Cash does none of these things. Asset 3. Stocks and index funds. For most people, owning entire businesses directly is not practical. That's where stocks and index funds come in. They are a way to own pieces of thousands of businesses with very little effort. Historically, The U.S. stock market has delivered around 10% per year before inflation. After inflation, that becomes roughly 7% real return. That difference is everything. Suppose you invest $500 per month into a broad market index fund. You do this consistently for 30 years. Your total contributions, $180,000 at a 7% real return. That investment could grow to $600,000 to $700,000. You didn't time the market. You didn't pick stocks. You simply participated. Most investment success does not come from intelligence. It comes from behavior. Staying invested, ignoring noise, letting time do the heavy lifting. Cash rewards none of these behaviors. Stocks do. Asset 4. Gold. Value preservation. Gold is misunderstood. People argue about whether it is a good investment, a bad investment. That misses the point. Gold is not primarily an investment. It is a store of value. A look at history. In the year 2000, gold traded around $280 per ounce. By 2025, gold trades roughly between $2,300 and $2,500 per ounce. Gold did not create wealth. It preserved purchasing power during periods when currencies weakened. Why wealthy people hold gold. Gold does not produce income, create cash flow, but it does protect against currency debasement, provide insurance. During instability, wealthy people use gold not to get rich, but to avoid getting poor. Asset 5. Stability-focused instruments. Not all assets exist to grow quickly. Some exist to protect capital and reduce risk. Government bonds and similar instruments serve this purpose. Why stability matters. Volatility creates emotional mistakes. Sharp declines cause panic. Panic causes bad decisions. Stability assets. Reduce portfolio swings. Provide liquidity. Allow long-term strategies to stay intact. Wealthy investors understand this. They don't aim to maximize returns every year. They aim to stay solvent and rational over decades. In investing, avoiding major losses matters more than achieving spectacular gains. Cash feels safe, but it quietly guarantees loss to inflation. Balanced assets reduce that risk. Each of these assets serves a different role. Businesses grow value. Real estate produces income. Stocks compound over time. Gold preserves purchasing power. Stability instruments reduce volatility. None are perfect alone. Together, they create resilience. Most people fail financially, not because they take too much risk, but because they take too little in the wrong places. They avoid volatility. They embrace stagnation, and stagnation is expensive. Once people understand that cash loses value and assets protect it, most still make one final mistake. They underestimate time. They think wealth is built by making the right move this year, finding the right investment, timing the market correctly. Wealthy people think differently. They understand that wealth is not built by timing. It is built by enduring, thinking in decades, not years. Most people plan their finances 1 year at a time. Some plan 5 years ahead. Very few plan 20. Wealthy people do. They ask questions like, where will this decision put me in 20 years? What will compound if I do nothing? What habits will quietly shape my future? These are not exciting questions, but they are powerful. A simple comparison. Imagine 2 people. Both are 30 years old. Both earn similar incomes. Person A saves cash, avoids volatility, keeps money in the bank, feels safe. Person B owns assets. Invests consistently, accepts short-term uncertainty, thinks long-term. After 1 year. Their lives look similar. After 5 years. Still not much difference. After 20 years, their lives are completely different. Not because one was smarter, because one let time work. The invisible power of compounding. Compounding is boring at first. It feels slow, unimpressive. That's why most people quit early. But compounding rewards those who stay long enough. A 7% real return doesn't look impressive in year one, but over 30 years, it transforms modest effort into substantial wealth. Cash does not compound. Assets do. Why patience is rare. Patience is uncomfortable. It requires delayed gratification, emotional control, ignoring noise. Modern society encourages the opposite. Fast results, immediate feedback, constant stimulation. Wealth requires going against that grain. That's why so few people achieve it. The role of mistakes. Wealthy people still make mistakes. They buy assets that underperform. They miss opportunities. They misjudge timing. The difference is scale. They avoid catastrophic mistakes. They don't. Over-leverage. Panic sell. Chase trends. They survive long enough for time to correct small errors. Survival is underrated. Why fire is misunderstood. Many people discover the idea of fire, financial independence, retire early, and misunderstand it. They think it means never working again, extreme frugality, escaping responsibility. In reality, fire is about options. It's about not needing to trade time for money, choosing work instead of needing it, removing fear from decisions, and that only comes from assets that generate value without constant labor. Retirement is a cash flow problem. Retirement is not about age. It's about income. If your assets produce enough income to cover your lifestyle, you are financially independent. If they don't, you are not. Cash alone cannot solve this. Assets can. Why most people never retire comfortably. Most people reach retirement with one major asset, their home, and one major strategy, hope. Hope the money lasts. Hope inflation stays low. Hope nothing unexpected happens. Hope is not a plan. Assets are freedom versus consumption. One of the hardest shifts wealthy people make is choosing freedom over consumption. They delay visible rewards for invisible progress. They drive simpler cars. They avoid lifestyle inflation. They reinvest surplus income, not forever, but long enough. Most people do the opposite. They upgrade lifestyles before building foundations. And once expenses rise, freedom disappears. Time is the real currency. Money is replaceable. Time is not. Wealthy people understand this early. They use money to buy time, reduce obligation, create optionality. Cash, sitting idle, buys none of these things. The final mindset shift. At some point, wealth stops being about accumulation. It becomes about protection. Protection of time, peace, independence. That is why wealthy people diversify, avoid unnecessary risk, Focus on durability. They are not trying to win every year. They are trying to still be standing in 30 years. Cash feels safe, but it erodes quietly. Assets feel uncertain, but they endure. Wealth is not built by avoiding discomfort. It is built by choosing the right kind of discomfort, short-term uncertainty, in exchange for long-term freedom. The question that changes everything, the most important financial question, is not what will happen next year. It is, what will happen if I keep doing this for the next 20 years? If the answer scares you, it's time to change. You don't need to be rich to think like the wealthy, but you must think like the wealthy to become rich. Cash has a purpose, but it is not a destination. Time rewards patience, assets reward discipline, and freedom rewards those who plan far longer than everyone else.